Before we begin, gently tap like if money stress ever makes you question whether you are doing something wrong. That small action helps this channel reach people who need financial clarity without confusing language or judgment. If topics like this resonate with you, consider subscribing so you never miss future videos about real money struggles. And comment the city or state you are watching from, because transportation costs feel different across America. Have you ever checked your bank account right after paying your car bill and felt immediate financial regret? Maybe you wondered how normal vehicles somehow feels heavier than rent every single month. If that feeling sounds familiar, you are not irresponsible with money, and you are definitely not alone. My name is Max, and I study why modern life quietly drains income even when people make responsible choices. Today, we are talking about what being car poor really means as we move deeper into 2026. Being car poor does not mean buying luxury vehicles or making reckless financial decisions without thinking. It means transportation expenses quietly consume money meant for saving, investing, and long-term financial security. In 2026, this situation has become normal for average American households, not a rare extreme case. Nearly 1 in 4 Americans now spend dangerously high portions of income just keeping their vehicles running. For many families, transportation costs quietly exceed food, healthcare, and sometimes even housing expenses. Financial experts recommend spending no more than 15% of income on transportation costs. Reality shows many households now spend closer to 20 or even 25% instead. That gap explains why money feels tight even when income looks reasonable on paper. This problem did not disappear after 2025, and 2026 continues pushing the same painful trend forward. Let us break down what owning a car truly costs in 2026 beyond monthly payments. The average annual cost of vehicle ownership remains around $11,000 to $12,000 nationwide. That equals roughly $1,000 every single month, leaving your household budget quietly. For many Americans, that number rivals rent in smaller cities and suburban communities. Monthly payments feel manageable, but insurance quietly adds another heavy financial burden. According to Bureau of Labor Statistics data, auto insurance premiums continue rising across the country. Fuel costs fluctuate weekly, but most drivers still spend hundreds every month commuting to work. Maintenance and repair expenses arrive unpredictably and usually during already stressful financial periods. Registration fees, taxes, depreciation, and opportunity cost quietly finish draining remaining flexibility. Payment thinking feels safe, but total cost thinking reveals the real financial damage clearly. That misunderstanding traps millions of responsible people inside long-term car poverty cycles. In 2026, the average new car payment remains above $700 monthly. Used vehicle payments remain above $500, far from affordable for many working families. Even worse, the average new vehicle price still hovers close to $50,000 nationwide. That amount could fund retirement contributions, emergency savings, or meaningful home down payments instead. Used cars now average roughly $25,000, eliminating traditional budget transportation options. Reliable transportation has quietly transformed from basic necessity into a luxury financial product. This leads directly into the most dangerous financial trap modern car buyers face today. In 2026, more than 1/4 of trade-in vehicles still carry negative equity. Negative equity simply means owing more money than the vehicle is actually worth. The average negative balance remains around $6,000 to $7,000 per buyer. That means people start their next car purchase already deeply underwater financially. This situation is not bad math by individuals, but structural failure built into the system. Rolling old debt into new loans compounds losses instead of solving affordability problems. Buyers carrying negative equity often face monthly payments approaching $900 consistently. To hide affordability issues, loan terms continue stretching longer year after year. 7-year auto loans now represent more than 20% of new vehicle financing. That commitment lasts longer than most people stay at jobs or even relationships. By year 5, many vehicles need repairs while payments continue relentlessly. This creates what economists describe as a poverty trap driven by transportation costs. The cost of being financially stretched makes escaping the situation increasingly difficult. Cheaper cars break down, repairs drain cash, and income stability suffers again and again. Missed work leads to lost wages, which makes transportation even harder to afford consistently over time. That financial pressure quietly repeats every month without dramatic warnings or obvious breaking points. Psychologically, this trap feels responsible because people believe reliable transportation equals financial maturity. You convince yourself the payment is necessary while ignoring how deeply it damages long-term stability. Being car poor affects far more than budgeting spreadsheets or simple monthly financial calculations. Nearly 40% of car poor households significantly reduce dining out just to afford vehicle expenses. Over 30% cut social activities because transportation costs quietly crowd out personal enjoyment. Vacations disappear, subscriptions get canceled, and constant stress slowly becomes a normal lifestyle. Transportation costs gradually isolate people from friendships, opportunities, and meaningful personal growth. Social isolation reduces job networking, career mobility, and long-term earning potential across adulthood. Many people eventually realize they are working mainly to afford driving to work every day. This financial hamster wheel feels like freedom until you pause long enough to question it. Younger generations experience this pressure more intensely as they enter adulthood already financially stretched. Nearly half of Gen Z struggles saving for housing or retirement specifically because of car expenses. Transportation now consumes a larger share of income than previous generations experienced historically. This places young adults at a structural disadvantage before their financial lives even begin. Housing feels unreachable when transportation absorbs potential down payment savings month after month. Education opportunities shrink when car payments dominate available cash flow relentlessly. Retirement planning gets postponed year after year without intentional neglect or irresponsibility. These repeated delays compound silently, creating massive long-term financial consequences. The opportunity cost of being car poor is rarely explained clearly to everyday Americans. Imagine spending $300 extra every month on transportation beyond reasonable necessity. That equals $3,600 quietly disappearing from your life every year. Invested consistently, that money could dramatically change future financial security and flexibility. Over 20 years, that amount could grow to roughly $150,000. That money could buy multiple vehicles with cash instead of endless monthly payments. It could fund a meaningful home down payment or early retirement safety cushion. Instead, it disappears into a depreciating machine, losing value every single day. Modern car marketing makes recognizing this financial trap extremely difficult for consumers. Advertisements emphasize affordable monthly payments instead of revealing total long-term ownership costs. Artificial urgency discourages careful budgeting, comparison shopping, and rational financial decision-making. 0% financing mostly benefits buyers who already have strong credit and savings. Longer loan terms spread unaffordability across many years rather than fixing the core problem. Interest quietly extracts thousands more dollars from households already financially stretched thin. This system profits from transportation necessity instead of genuinely solving affordability issues. Transportation should never function as a wealth extraction machine for working families. If you feel trapped by car costs, it is not because you are careless. It is because the system makes basic mobility extremely expensive for average Americans. Understanding this reality removes shame and replaces it with clarity and perspective. Awareness becomes the first step toward protecting your financial future intentionally. This video is not telling you to sell everything or make extreme changes immediately. It is about seeing the full financial picture before making your next transportation decision. Small mindset shifts can protect long-term financial health more than sudden drastic moves. Transportation should support your life goals, not control every financial choice you make. In 2026, the most valuable financial skill is not simply earning more money. It is protecting income from silent leaks, draining future opportunity and freedom. Cars represent the largest silent leak for millions of American households today. Fixing that leak changes everything else downstream in your financial life. Take a moment to reflect on what your car truly costs you monthly. Not just money, but stress, options, and long-term control over your life. Many Americans believe earning more money will automatically eliminate the financial stress caused by car ownership. Unfortunately, higher income often leads to purchasing more expensive vehicles rather than improving long-term financial stability. This pattern is called lifestyle inflation, and it quietly keeps people trapped in the same transportation cost cycle. Bigger paychecks rarely solve problems created by systems where mobility itself has become structurally overpriced. That is why understanding car poverty matters far more than simply chasing raises or promotions. In most parts of America, reliable transportation feels completely non-negotiable for basic survival. Without a car, accessing jobs, healthcare, education, and social life becomes extremely difficult or impossible. This dependence gives the transportation and lending industries enormous power over household financial decisions. When something becomes mandatory, price pressure disappears, and long-term affordability stops being prioritized. That reality explains why vehicle ownership keeps becoming more expensive year after year. Rural and suburban households experience car poverty far more intensely than dense urban communities. Longer daily commutes increase fuel costs, maintenance expenses, insurance premiums, and depreciation simultaneously. These households often lack alternatives like reliable public transit or walkable infrastructure. As a result, car poverty hits hardest where families have the least flexibility. Geography quietly shapes financial outcomes more than most people are taught to realize. Many households delay necessary vehicle repairs because they cannot afford unexpected transportation expenses. This delay increases safety risks while also raising future repair costs substantially. Driving unreliable vehicles creates constant anxiety about breakdowns, missed work, and emergency situations. That stress compounds existing mental health challenges caused by long-term financial pressure. Car poverty quietly damages emotional well-being, not just bank account balances. Relationships often suffer when transportation costs restrict social activities and shared experiences. Friends stop extending invitations when you consistently decline due to financial limitations. Over time, social withdrawal begins to feel normal instead of concerning. Isolation then removes emotional support during already difficult financial periods. This feedback loop deepens both financial strain and personal hardship simultaneously. Parents experience additional pressure when vehicle costs interfere with family responsibilities. School events, medical appointments, childcare schedules, and emergencies all depend heavily on reliable transportation. When cars become financial burdens, parenting stress increases dramatically and persistently. These hidden pressures rarely appear in traditional financial advice or budgeting discussions, yet they shape daily decisions for millions of American families. The used car market no longer provides relief the way it did for previous generations. Limited supply, strong demand, and financing practices keep used vehicle prices historically elevated. Buyers often pay near new car prices without new car reliability or warranty protection. This removes the traditional stepping stone toward affordable, dependable transportation ownership. Entry-level mobility has effectively disappeared for many working Americans. Modern financing structures make this situation appear manageable while quietly worsening long-term outcomes. Low down payment offers increase financial risk rather than reducing monthly stress. Extended loan terms delay equity growth while accelerating depreciation losses. These structures prioritize lender profitability over borrower financial health and stability. Understanding these mechanics empowers consumers to question harmful transportation norms. Escaping car poverty often begins with redefining what transportation necessity actually means. Not every upgrade marketed as reliability or safety is genuinely required. Slowing down vehicle decisions can protect years of future income and flexibility. Awareness creates space to evaluate alternatives instead of reacting emotionally. This mindset shift alone can dramatically improve long-term financial outcomes. Car poverty survives through silence, confusion, and misplaced personal blame. Open conversations about real transportation costs reduce shame and increase clarity. Financial awareness spreads when people share numbers instead of appearances or assumptions. These discussions challenge systems that quietly drain household wealth every month. Change begins when understanding replaces guilt in everyday transportation decisions. Many people stay trapped because car expenses feel unavoidable, so they stop comparing costs to real priorities today. When an expense feels mandatory, your brain treats it like rent, and you stop negotiating anything around it. After months, the payment becomes background noise and financial stress becomes your baseline mood instead of a warning. That baseline makes you accept less saving, less joy, and less freedom because it feels normal everywhere now. Car poverty grows quietly when normal people keep paying, hoping next year will finally feel easier somehow again. Most households never calculate how many months of payments equal one emergency fund, and that is dangerous math. If you delay investing even 2 years, compounding shrinks and catching up later requires much larger contributions monthly. Car poverty steals optionality, meaning you cannot say yes to opportunities because your cash flow is locked tight. It also steals time because extra shifts pay for repairs, leaving less time for relationships and growth too. When time disappears, health habits slip, stress rises, and money decisions get worse, creating a loop for years. Typical advice says cut coffee, but coffee cannot compete with a $700 payment and insurance alone. This mismatch makes disciplined people feel broken because they follow rules, yet the biggest leak stays untouched still. A realistic budget begins by naming transportation as the first problem, not the last after leftovers each month. Once you see the real numbers, you realize small trims cannot fix a system-sized expense like this. That honesty hurts, but it gives you power because clarity beats optimism when bills are due every month. Many Americans fear an unreliable car more than long-term debt, so they upgrade under pressure quickly today. Dealers and ads amplify that fear, promising peace of mind while quietly selling you years of payments ahead. But financial security is not a newer dashboard. It is cash reserves and manageable commitments for long-term survival. When payments rise, you trade future freedom for present comfort, and that trade often goes unnoticed at first. In 2026, comfort is expensive, and the bill arrives in missed goals, not just monthly statements for years. Escaping car poverty starts with one hard habit: slowing down decisions when emotions scream urgency at you daily. Waiting one extra week to shop can save thousands because desperation is always priced higher in every deal. It also helps to separate needs from wants because marketing turns wants into fake emergencies for most buyers. You do not need perfection, you need a plan that reduces risk and protects cash flow each month. Plans fail when life surprises you, so resilience matters more than looking successful in a parking lot today. Fixed car costs reduce resilience because you cannot pause payments during layoffs, illness, or family emergencies ever easily. When money is tight, one breakdown can trigger overdrafts, credit card debt, and missed rent within days fast. That is why transportation becomes the first domino, knocking over savings, plans, and confidence at once for families. Even steady earners feel fragile because their budget has no slack after insurance and payments every single month. Fragility feels like constant anxiety, and anxiety pushes rushed decisions, which lenders are happy to finance for profit. None of this is about blaming you, because the system was built to make cars feel required everywhere. But once you understand the pattern, you can protect yourself by asking better questions before signing anything new. Ask what the total cost is, what the term is, and what happens if income drops suddenly tomorrow. Ask whether this purchase moves you toward goals, or simply makes commuting slightly more comfortable right now only. Intention beats impulse and patience beats pressure, especially when a decision can cost you 7 years of payments. Transportation should expand your options, not shrink them, and a good car choice feels boring but safe financially. If a deal feels exciting, slow down, because excitement often signals manipulation and rushed commitment from sales tactics. In 2026, questioning transportation costs is financial self-respect, and it protects future versions of you so much. Your future self does not remember the trim level, but it remembers the peace of having savings available. It remembers choices that lowered stress, opened options, and allowed you to say yes to life more often. If this video gave you clarity, subscribe, because we break down real money problems without shame or hype. This channel exists to help you feel calm, informed, and capable, even when the economy feels chaotic today. Share this with someone who keeps saying they are fine, while their car payment says otherwise every month. And comment one number, your monthly car payment, because seeing real numbers helps everyone feel less alone here. Honest numbers create honest decisions, and honest decisions create freedom faster than pretending everything is normal anymore today. Take 30 seconds tonight and list every car cost, including insurance, fuel, repairs, and parking fees too, please. Then compare that total to your savings goal, because the comparison reveals why progress feels slow right now. Progress begins when awareness becomes action, and action begins with one decision you can repeat consistently each week. In a system designed to extract wealth, clarity is your advantage, and patience is your protection every time. So ask yourself honestly in 2026, are you driving your car, or is it driving you quietly still?